Hello, Warriors. Everyone doing okay? Brock, how are you? Hi, Mark. So you think this is a treat between S&Ps and NASDAQ? To me, it's a treat because I have a market tell that gives me conviction about what to do. Want to welcome all our viewers from investing.com. How you doing, DJ? All right, so Mark's talking about the weakness that we have in NASDAQ compared to S&Ps with NAS coming in down over 1%, 1.3, and S&Ps down less than 1% at 0.7. And I wanted to talk about the fact that the S&Ps made a new high here, and the NASDAQ so far had a failing rally. Okay. And I still think it's possible that even if the S&Ps makes another new high, I know a lot of people are looking for 3258, which is 88% back from the highs before the March COVID crash. My best guess is that NASDAQ maybe gets back to 108.50. And for everyone who, uh, investing.com people, this candle here, I believe, is very significant. In fact, my associate, Steve Volge, found a tweet that the last time we had a key reversal in NASDAQ was back in the dot-com era. I believe the high in the year 2000, not 2008. So it's my contention that this stands, and should the S&Ps hold together, let me just look at a weekly with a day left to go. It'd be something if we ended up with a key reversal weekly signal. We're not going to have a sell signal in my 2-week reversal work unless we close by tomorrow's close 10,339, which isn't impossible. That's 200 here, but my preferred scenario is that we rally one more time as the S&Ps make new highs, maybe back to 108.50, and then back under 10,003. We have some problems in Houston, 10.4. So a break under 10.4 is going to take you, which is really important should this happen. And Blake has this is a bull bear line. This is the old historic highs from, I believe, 2008, 97.45. And if we break 10.4, that's where we're going. Any questions on that? I guess you could say that the market, what I've learned, and I knew a lot of spread traders, is that the spread will turn before the market. So when you start to see changes in behavior, and right now what they're doing is they're rotating it to Russell. Russell had a great day yesterday, so they're going to what's cheap, rotating. After Russell, I don't know what they're going to rotate into. Maybe back to tech, but I doubt it. So they're all looking for unexploited areas, and I believe I do have the Russell here. It had a very good day, but as you can see from the Russell, I have it here somewhere, IWM. Here it is. That when you look at the Russell, it looks pretty good, doesn't it? Comparatively, we still haven't come close to challenging the highs of late May, early June, but this too looks like a better chart than what we have happening here in NASDAQ. So um, that's where they rotated to yesterday. I think Russell was up 3%. Okay. So IWM is an ETF for it. And then we actually have another change that hasn't happened for a long time. I think it's important. I was waiting for gold to make a new high, but check out silver. I don't think you could find a prettier third drive. It's a textbook example. So silver right now you have down 0.9% compared to gold down 0.2%. and that too is a change in market behavior. And if the saying holds true that the spread turns before the markets, the spread I'm talking about here would be the gold silver ratio. And we're up today with silver being weaker. And you take a longer term view, I'd say that after having a break from way up here, that we're due for some type of bounce in this spread, and back over 100 is, could generate a rally maybe halfway back. I'm thinking back to 108 is possible. Uh, this was an important support level after the first break. So a couple of important things happening this week, right? That there might be a little shift in market behavior, and that's between NASDAQ, which is outperformed by, you know, eons over the S&P. Seeing a shift there that, it is going to take some time to confirm that. It's going to take a few attempts of, the S&P is making new highs without NASDAQ 100 confirming. And it may take a few tests in silver with to see if gold is going to hold up better. And what would be classic would be gold making a new high, which it tried up here, but only got to 1815. Let me go to a shorter term chart. It still looks possible unless it's just going to be one of these quiet rolling tops and just rolls over. But if we get a new high, something I've been talking about, and I'm trying to be patient for it, look at the RSI down here on the 4-hour chart. So unless it's a move to 1900 and it's so extreme, I really don't see the RSI being able to get over 70. Even if gold trades 1830-ish, the top range I'm looking for is between 22 and 40, which I know doesn't seem specific, but in this business, it's close enough for government work. So I'm going to be real interested to see where silver is if gold could do that. What I just, sure, you can always ask questions in here. Go ahead. What is it, Bishwatch, before I turn it over to the team? Is that your question? Can I ask one? Yes, you can ask a question. Okay, so dollar, still not doing anything right. It's a real grinding type of decline, and sure looks like they want to go for at least this low down here, 95.72, not that far away from it. I guess the question is going to be, are we just going to take out this low but hold this low? So it kind of looks like a lot of things are setting up into next week. We'll see. That's just how to know that it's a reversal or a pullback. They're both the same, and you never know until you look back in your rearview mirror. And it's all also based upon time frames, right? So it could be reversal for 3 hours. It could be a reversal for 3 weeks. And even that, you could call a pullback depending upon the trend. Does that help at all? But, it's almost like a market top. You really only know if it's an important high when you look back in your rearview mirror after some time has passed, right? You could believe it is, but you never know it is until you have some history. Okay. So euro stronger than cable today. Here's your daily look. I don't see any reason to short it yet. How long is a piece of string? It depends on where you cut it, DJ. So, I still don't see a reason to short euro. I mean, we are starting to diverge a little bit up here, but I'm going to really be paying attention to the dollar index. And, the big question is, are we going to turn it before here, or is this really this is something Blake will be with us in a second, or is it more significant and we're going to break all the way to the 92 level? You know, a lot of bears. If you look at the DSI, I don't think I've seen the dollar index this low. I mean, it's not 9 or 11, but I think we're in the 20s now. Okay. So I'm going to save those questions for Steve and Blake. And I want to invite everyone to become part of our community. I think Joe Perry's back, so I could maybe offer a Thursday special to anyone who's watching us at investing.com to get our research, get push notifications to your devices, and be on top of all of these different instruments that we cover. And not just the instruments, the different methodologies that are used: Elliott wave, harmonic, basic technical, candlesticks, and macro. All right. And all the great research that would take you about, I don't know, 400 hours a week to do. But with a team, you can accomplish a lot more than you can individually. And I've been around for a while. Blake will tell you how old I am, but it's the best group of talented, insightful traders and people who care about what happens to you in the market that I've ever been part of. Okay, so you may want to consider this as an investment in your training career. So here we go. Blake, I want to turn it over to you. You've really put together a great team. And I'm wondering if you think Euro is getting a little bit too stretched up here.
Ahead of the European Council meeting, and good morning, by the way.
Yeah, good morning, man.
Let's talk a little bit about the euro. I actually had a pattern in play going, and I bought it around here, and then I closed it around here within like a pip or two where I bought it yesterday. The problem with the euro at this point is, like I said, we have the ECB just came out, and they're leaving
Okay.
their pandemic bond buying program the same. They left rates unchanged. Now we'll have to see what Lagarde says. But the most important thing is the European Council meeting this weekend, and I'd rather have some euro long exposure going into that, even though there's probably only a 50% chance they patch some sort of agreement together. I'd still rather be long than short. So, but today, what I'm hoping for, and this is going to go along with the bias chart here in a second. So you can see this fib here.
Yeah.
We basically came down and we were coming close to this 113.70 breakout point, but I'm actually looking a little bit deeper towards 113.50, maybe even later today if we can get down there, and if we get or even before the weekend. So what I'd like to see is I'd like to see the euro pull back towards 113.50 and try to get some longs down there. And like I said, I'm not sure if it's going to happen, but that's like what I'd like to be is I'd like to be long going into the weekend, because even if the European Council puts together some sort of fund that shows that they are unified, and it doesn't even have to be a big fund. It doesn't even have to be some overarching massive agreement. But what it's showing you and showing us is some fiscal, you know, cohesiveness, and if that happens, I think that's going to be bullish for the euro. It may not translate into anything else other than being bullish for the euro. You could probably play the euro against almost anything, but it is something that I'm thinking going into this weekend. So let's talk about and Dale, that you asked, your your initial comment was it's a little stretched here. I mean, it is, and a lot of traders are probably looking at it as a false breakout, but I wouldn't weigh too heavily into that
Yeah.
ahead of the weekend, especially with this meeting over the weekend. So let's talk about support. I just kind of gave it to you, 113.50. is going to be support for the euro on dips. I think that's going to be an important support because I'll pull it up again. Let me delete this really quick because we don't need that unless we
That's your
start
green
actually.
line there.
Uh,
Oh, well,
well,
underneath it. Yeah, I see.
yeah, the 113, and let me move this really quick. We don't need this for right now. This will be a little clear. 113.44 is a 38% retracement. Remember, these are all highs that we were testing around the 113.50 level. We couldn't break. So 113.50 is going to be support, and I think that's going to be right there. Let's see. Resistance. Obviously, we just got to note the resistance from yesterday, which is going to be 114.53. So I'm just going to average that out at 114.50. Okay. Let's talk about the cable. So the cable, the cable is a little concerning to me while we're below, and this is the same thing that we'll talk about that we talked about yesterday. 126.70. I'm just going to try to do this for you really quick because I want to get this done before Steve gets here. 126.70. I think that's key resistance. And remember, when I put an asterisk, for those of you that are unfamiliar with me doing a bias chart, it's something I've done for years and years and years for our listeners. And I kind of, because Paul Franco had been doing it and he still does it on the European crossover, I had not been doing it here, but I think it's something that's really important. I think it's good practice. So I'm going to try to do it every morning as long as we have time. So this is key resistance. It's a multi-year or not multi-year, but it's multi-month trend line, and it comes in at basically at 120 at this high at 126.70. Okay, now support. I mean, we probably have to look at overnight support, but because I think what might be happening here, and we'll find out, is we might be just developing some sort of triangle. So this support right here will be 125.20. 125.20. And by the way, I need to adjust this. So euro dollar still is I think in a bullish trend. As you guys know, I've been a euro bull as long as the euro is in this bull flag pattern. We have to come back down below. At this point, we'd have to come back all the way down below like 112.30 for me to, not be bullish. It's still a bull flag pattern. All right. Cable, on the other hand, by the way, I think it is sideways. It's range bound, but I would be very bullish to cable if we broke above 127. Let's go over to the Aussie. The Aussie. Okay, so yesterday was in my opinion, big rejection in the Aussie because this is a triangle it's trying to play out, but the risk is here that we could not break above this 70.30. And I'm going to write that down as pretty key resistance. I know we have a spike high up here at 70.60, but 70.30, in my opinion, is really key because those are going to be the highs back here from December of last year. So 70.30. Key resistance. I got multiple, asterisks there because what I'm seeing here with the Aussie now, and let me take you intraday. So we have a head and shoulder pattern. We've basically knocked our head up against the neckline. The neckline comes in intraday, let's just say roughly 69.90 to 70 cents. So this is all like resistance zone, right? All through here. But it really, if the head and shoulder pattern plays out, right? I was showing this chart to our traders in our chat room, so that's why it's all drawn out. We're pointing towards 69.30, which, as you guys can see, 69.20 is all really key support. Now, what's really important about this is this is something you have to think about. We've had the Aussie dollar rally, try to break out. Equities are higher. We're kind of reversing a little bit. If you haven't looked at the Shanghai Composite overnight, Shanghai Composite's come off quite aggressively. This is a 1 hour chart, but you can see it's come off pretty good. So and that might be weighing a little bit on the Aussie. So if the Aussie rolls over, if stocks start to pull back, if we break through this lower trend line here, the Aussie dollar will and should come back down towards 67 cents. Now, I'm a little worried about the Aussie because it's just not following through with stronger stock market risk appetite. So right now, key support is at 69.20. Period. End of story. No if and or buts about it. I'm sorry. I gotta continue on. 6920. This is really key support. So you can see we're just kind of bouncing around in this 100 pip range, which move outside of this range is going to be pretty big. All right, so Kiwi, same thing as yesterday, although this was my chart of the day. I didn't want to do that. This is our chart of the day yesterday. My bad. There we go. This is, setting up, oh, that's why it is. It's right here. Setting up what could be a cup and handle pattern. I know it's a little jiggy right there, but this basically just illustrates to you, which we all know here is 66 or 65 cents is support, resistance is 66 cents, and that's it. And it's bullish until we break. It's bullish until we break 65 cents, and if we break 65 cents, it'll turn us back to like range bound, because then if we break, so see, we're already over this multi-year trend line. You can see this multi-year trend line here, right? We're already above that. So now it's bullish until we break below 65 cents. We break below 65 cents, we should go back and see 63.75, and then we're just going to be range bound. People will look at it as a false breakout, but whatever. Okay, dollar Canadian was super heavy yesterday, following the Bank of Canada, but we held the 200-day moving average, right? So that just solidifies and reinforces how important this 135 level support is. 135.
Triggers head and shoulders below
What?
that.
Yeah,
Triggers
yeah,
head
but
and shoulders, right?
I don't like.
Yeah, me too. It's not my favorite continuation pattern, if that's what you're about.
No, it's not. Well, that's the problem, Steve. It's not a continuation pattern.
Yeah, but we had an initial rebound.
People will still look at it and they'll go, oh, look, a head and shoulder pattern. But it's not. That's the problem with, I think most people get caught up in this trade. Then they sell a breakdown and then it reverses on them. That's what I think is what happens to a lot of people. So that's why I try not to look at it. But yeah, I see what you're saying. Also, we're going in the ECB press conference for my office. Okay, so a break above this 136.50 would be pretty bullish because it's this trend line. So I'm going to write that down. Sorry, let me turn this down a little bit. 136.50 resistance. We are in range for now. Okay. Dollar Swiss had a huge move yesterday, and it's not just the dollar Swiss, it's the Euro Swiss. Euro Swiss is what really had a big move. We're trying to break this downtrend line, pretty minor downtrend line. I wouldn't get too excited about it, but what I'm really looking at right now is high. You can see this high from right here, right? High, low, low, high. Today is high. There. So today's high is probably going to be pretty important. That comes in at 64.66. And if you use Forex Analytics, you already know that I was expecting a bounce when we were down here because of this false breakdown. When we did this false breakdown, the analysis from last week is like, yeah, you got to be careful of a little bit of a bounce, and we've got it. That doesn't mean that that's. I mean, from here, I wouldn't be too worried about it. I think we're bouncing around between now. 73, what is it? 73, 75, basically. But a break above that should squeeze us back up towards, 95,
Could
50.
that false breakdown also be called a stop hunt?
Yeah, a little stop hunt down there. You bet. 93.75. Let me just write that down.
Maybe I'll use it
Oh,
for my
wait.
Twitter handle.
93.75, and this would be 94. I don't know why I would 64. Dyslexia kicking in. Okay. Dollar yen. Let's go to the dollar yen. We have this downtrend line is capping us, and it's capped us like the last couple of days. So that, and it comes in right almost at today's high. So it's actually going to come in right here at 107 and a quarter. 107.25. Range, still the same there. Support 106.60. We have to be careful of the dollar yen here forming a bit of wedge. Right? Okay. So like a little bit of a wedge there, which is a bearish wedge, by the way, just FYI. Okay, so we got dollar index. So nothing's really changed with the dollar index because we probed below this trend line yesterday, but didn't break, and that worries me a little bit. If you're short the dollar, you got to be a little thinking, So that's what makes this low right here extremely important. And by the way, this is something else as big. Here's a weekly chart. Low, trend line support actually comes in right at that, which is the pink line, which you'll see right here. Should I say magenta? Just kidding. 95.70.
Pink, like Pinkert.
Like Pinker. There you go. 95.70 key. I don't want to be too. I mean, it's right now. I'll put it this way. It's bearish because we do have this flag, and if you guys have heard my analysis the last 2 weeks, I'm bearish because we got a flag. But if we hold this and we reverse, we get back above. Now it was 97. Now it's this trend line comes in around 96.60. That everything changes. 96.60. Okay. Dollar MEX, ECB. Do we have data coming out, Steve?
We have
yeah, we have.
Yeah, hi.
We have initial jobless claims. We have retail sales. We have
Gosh,
Fed.
it's Thursday already?
Yeah, we have
okay.
Philly Fed continuous
okay.
jobless claims. That's
I'm just trying to get all this done. 22. I could actually do it while you guys talk too. It's 22.15, and right here is 22.71. It's range, but this is now very important resistance. I want to do gold really. I'm gonna run out of time. I can do it anyway, but I put the S&P on here because I think it's important. 22.45. 22.45. Wait. I'm sorry. 32.25.
So we have data in 15 seconds. Initial jobless claims expected to come at 1.25 million. Continuous jobless claims expected to come at 17.6 million. US retail sales expected to come out at 5. and Philly Fed manufacturing expected at 20. So let's see what we get.
I'll finish everything up soon as this data comes out. Oh, there we go. Retail
Seven
sales
and a
strong.
half retail
strong.
sales.
Yeah.
Continuous jobless claims just a little bit better. Initial jobless claims worse at 1.3 million versus 1.25. Revisions are nothing to really.
I think the
worth
market's
mentioning.
going to like this. The market likes everything. I think it's going to like these numbers.
Yeah,
Actually,
of course.
futures are ticking a little lower right now.
Interesting.
And by the way, the ECB press conference is starting. Hey guys, let me while you guys talk, let me just go through this really quick. So, good morning, guys. How are you?
Good morning,
Very
mate.
well, very well. Good
Good.
morning.
I'm just going to
So-
wrap this up really quick.
Yep. I can
Go ahead.
take over if you wanna do the numbers, and I'll be talking. In the
Well,
middle.
no, let's leave this up. Why don't you guys talk
Yeah.
through what you guys are thinking today?
Stelio, go ahead.
Yeah. I mean, the main theme today is that of improvement. We had quite a bit of data coming out better than expected. The main one was Chinese GDP. You know, do we believe it or not? It was still a huge beat from negative 9.8% quarter on quarter to plus 11.5%. So if you look at the historical charts, obviously it's been around 1.5% or something like that quarter on quarter before the COVID. It was down 10%. Now it's up 10%. So it's like, yeah, this is it.
Yeah, having said that, the Shanghai Composite closed 4.5% lower.
Lower, yeah.
Yeah.
But that was definitely a good print. We had the Australian employment change, and again, it was
four times full-time employment. It was like 4 times the size of part-time, right? But on the wrong direction.
Yes. But
Sorry.
still, the headline number it was very good, and it was basically the exact opposite of last month's negative number. We still had the previous month, so that was May was a big minus 600,000. But basically, that's what we're working off now. So overall, it was it's good numbers, and also out of the UK, we're expecting another 250,000 jobless claims. They actually dropped by 28,000. So it's, we're getting some good numbers, which reflects, all economies opening up, etc. The question remains, how do we move on from here? The way, especially in the US, the way they're counting unemployed or employed people, the people who are on aid from the government, who are receiving checks and all that, they're still counted as employed. So we have to see what happens when government support stops and things balance out somehow. And so I'm still cautious, although the numbers today were good. I'm still a little bit cautious to see how things go. And we have to remember also that things are not moving in the right direction regarding COVID. There's more lockdowns, either local or more general, and restrictions on things people can do in various countries like Hong Kong and the state of California and whatever. So we had the peak, we had the recovery, but now it seems like we're getting close to going to another peak again. So I hope I'm wrong, but I think this might be happening.
It reminds me of what Peter Bookvar was saying yesterday, Stel, and I found it really interesting. Only Bookvar could come up with this, is that he's worried about the supply chains. He's worried about when the economies begin to heal and rebound, that it's going to generate inflationary pressure, which is going to put some upward pressure on yields. And actually, the theme is that a recovery can end the recovery. So it's almost like when we're in a malaise, the Fed has more leverage to keep things afloat. But if we get a recovery with demand coming back and supply chain disruption and inflation numbers going up, that could upset valuations and the recovery in the economy.
Yeah, absolutely. Supply chains have been damaged, and I was reading yesterday. It was one of the main retailers who said they were putting our prices up to reflect, increased transportation costs and everything. So that is a very good point. And also, as our friend DJ is saying, bankruptcies are continuing to spike. And this is not something you can reverse from 1 month to the next or a quarter to the next. So I'm still very cautious, and I think that's how the economy is going to be, and people are going to be. The spending habits. You're not going to go out to exactly where you were before COVID started. It's going to be much more gradual and cautious. Or maybe that's just me. I don't know. I could be wrong. But
it's not just you, Stelio. Just look at the. I mean, whoever really wants to, read what's happening, you just have to see what the companies themselves expect. For example, and this is one of the literally thousands of examples. As you know, Jason's godfather, is a pilot. So he has a friend that was a pilot in Emirates, and he just got fired. So in the letter he received from Emirates, in essence, among other things, it says that they don't expect demand to normalize for at least 18 months. And whatever company and their assessments that you look at, some of them are talking about 18 months, some of them are talking about 24 months, which is 2 years, some of them are talking about 3 years or more. So, people that are actually working in industries and they have a very, very good idea of the damage that, each industry has in essence suffered already, and, has a decent understanding of, what a recovery might look like. I've seen nobody being really optimistic about it. And we had warned in advance that at some point after the lockdowns were over, we would see numbers, recover, which could sustain the euphoria that began by the trillions and trillions of monetary easing. But sooner rather than later, I think it's going to be more than obvious that, yes, of course, you're going to have numbers recovering once you open up economies that had completely shut down. But will the recovery be enough to bring us even, close to where we were prior to it? And, I think the answer is clearly no.
Which where we were prior to it, remember, was the whole of the global economy turning lower.
Yeah,
So
we anyhow had
years,
very clear signs of a slowdown during the past 18 months. Yeah.
So it's yes, the central bank action has been huge, of course, but you can't solve everything with with low rates and buying bonds and all that they're doing. Obviously, helicopter money is good. That will help. So the checks that they're writing actually do help. But what does that do to real?
They help. They help as long as they help as long as the currency still maintains its value, because inevitably at some point with universal basic income, which I think they will, throw in the mix sooner rather than later, which is in essence helicopter money, right? And with everything else, I think it's a matter of time to actually, and there is where I agree with Peter Bukvar's assessment yesterday. I think that sooner rather than later, now we've gone past the part that what has been done will mostly stay in asset prices. So the inflation created, I think it's soon going to be spilling outside of the financial markets. And there is no solution to that problem, because the only solution to fight inflation is raising rates. But how do you raise rates in an economy, in economies in general, that are A, over indebted, B, over leveraged, and C, addicted to free capital, to free money? I mean, it's going to be a disaster.
The problem is that central banks are painting themselves into a corner. They just cannot raise rates because of the reason you said. So it's very difficult for them. And global debt, just like our friend Sean is saying, the IMF said that debt is a serious concern. And I was reading today that the rate at which global debt is rising is obviously a record this year,
Of course.
and the last record was last year, and it just keeps going like that. So
Yeah.
how do you get out of that? It's you just can't. So they have to keep going, which is insane.
And really, I hope there isn't anybody foolish enough to believe that you can keep doing something like that internally, right? I mean,
Yeah.
you know,
They-
this is unsustainable. Yeah, it's not easy to predict if the impact of all this is going to hit the markets, because all these start mattering suddenly until, you know, they stop, they don't matter until suddenly the market wakes up. Some, you know, often it's based on some specific event or whatever, and then suddenly the market starts caring about it. But I mean, how long is it still going to be? Half a year, 2 years? But
Yeah.
you know, it can't be that long, because as you said, the trajectory, second derivative in essence of, you know, the debt is, you know, I mean, is just increasing, right?
Yeah, and
So
remember
we,
last time the Fed tried to do some quantitative tightening, 2018, late 2018. Remember what happens with stock? They just had this tantrum, and you know they don't like it at all. So you know it's a very difficult situation to get out of, I have to tell you. And you know what? The other thing I always say, look at what the smart money is doing. And you know, I have a few friends. One of them, you know, I've told you about him. He's a ship owner, quite rich, and he's piling into real assets. He's buying. He likes cars, so he's buying like rare cars and watches and stuff. He's just piling into that because he's expecting inflation, and he wants things that are kind of, you know, broadly indexed. So this is interesting. Anyway,
no, I'm totally with him. I mean,
yeah.
and you know how it is. It's also self-fulfilling prophecy. I mean, once a lot of market participants start realizing that inflation is going to be inevitable, you know, there's not going to be an easy an easy way to reverse
Yeah.
that, right?
Yeah.
And then the whole situation is going to blow up. It's also going to create a, you know, a lot of social unrest, and you know, then things will start going south. But anyhow, one thing at a time. Stelio, whatever news we get from Lagarde, because she has actually started
Yes, I will
speaking.
interrupt.
She's already said, by the way, just some headlines that the risks remain on the downside, that weaker demand is going to put pressure on inflation, that they expect inflation to fall for the time being, but then to start picking up next year.
Yeah.
Yeah,
Okay.
more or less what you would
Yeah.
expect. That
Nothing new yet.
yeah, that the economic contraction is in line with what they already expected. That we're seeing the early stages of the recovery. You know, nothing really that matters so far, or nothing that's going to move the market so far. And as you see, the euro is more or less uninterested so far. The daily candlestick is at the moment like a doji, a perfect doji, which means that we're completely unchanged on the day. Yesterday's price action was not very bullish, given the fact that we moved substantially higher initially, but closed um, almost unchanged. But I consider that also normal, in the sense that having the ECB today, you know, as we were getting closer to the end of the day, you know, some people would want to square their positions or trim their positions lower. So I think it might have been, you know, partially profit taking in people that were already long and had profits. So I wouldn't pay so close attention to yesterday's candlestick, not unless we get quite a bearish candlestick today. So if today's candlestick is not like very bearish, in which case we can even, you know, produce some type of an evening star formation. You know, nothing really changes here. I think that the path of least resistance remains higher. It is important to see how we're going to close today, given the fact that yesterday incrementally we closed above this long-term descending channel. I still think that in general the path of least resistance is higher for the euro, and you know, the pound hasn't been performing that well today. But on the other hand, you know, nothing really bearish to talk about here. I see this more as a short-term consolidation after this rebound higher. So I still see the dollar being under pressure, and I still think that the dollar might continue to underperform, sorry, unless or until we see a decisive turn lower in risk assets, which, I'm expecting that it's going to happen soon. The question is not if it's going to happen, because we've already moved substantially higher. The question is, for how long is it going to happen? Is it just going to be like a corrective pullback that's going to last, a few days or a couple of weeks at most, or is it going to be something a lot bigger than that? That is going to more or less determine the fate of the dollar. But as long as indices remain well bid, and so far they do, admittedly, I find it quite interesting that the Nasdaq, after posting this really big reversal candlestick, hasn't really recovered, oppositely from the S&P, which yesterday actually produced a higher high. So it's not very frequently that we see the Nasdaq diverging to the S&P, with the Nasdaq being actually weaker. But I find it quite interesting, and I'm monitoring this on the short-term chart as well. So, let's see, I'm monitoring this as ascending channel here. Let's see if this move lower can actually find support there, or if we're going to break lower, in which case I would expect more weakness, not only in the Nasdaq in that case, but broadly. As we discussed yesterday with Peter, and I totally agree with him, an explanation for perhaps reversing the period in which we saw the Nasdaq overperforming the S&P is if market participants start believing that we're actually recovering from the coronavirus economic problems, in which case they might try to rotate from already, extremely highly valued, the least to say, I don't want to use stronger terms, tech stocks, to perhaps some of the stocks that haven't yet seriously rebounded following the low that we found. And this is one possible explanation. Now, on the other hand, I would have to argue on that even if we turn lower in risk, there is still a chance that the Nasdaq might underperform for a period of time, given the fact that tech valuations have become ridiculous once again. I mean, in some cases we're toying around with, in some companies we're toying around with valuations that we had only seen back in 2000, in the tech bubble. Didier says Tesla down 5% in pre-market. Speaking of bubbles, that's undoubtedly one. In any case, let's have a look at Stelio. Anything interesting from Lagarde?
Nope, nothing yet, I'm afraid.
So far, she's
just repeating,
going through
the same stuff.
The usual textbook. Yeah.
He's wearing an interesting pink colored.
Yeah, I saw it. Yeah.
I like that.
Okay, so let me go through a few more stuff. One of them is crude.
She's wearing pink still?
Yeah, she's.
Oh, that's her secret message to me. You know my last name, Pinkert. So she's, I have an inside track to the ECB now, guys.
There, Dale, if you want to see what she's wearing, there you go.
Oh gosh, thank you, Steve. Oh.
Nicola was just
getting old isn't easy.
Tweeting about. So crude oil. I know you know.
You will. And may you be able to find out.
Okay.
That's my hope. Okay.
Thank you.
All right.
Crude oil testing resistance, still monitoring this divergence. I do think that even if we see a higher high, which is likely, we are going to maintain this RSI divergence, because I believe that we're very, very late in this rebound. So I don't think you should be jumping on this rebound at this point. Even if we see a new high, even towards the 61.8% fib at 44.80, I think that we will probably reverse strongly to get some type of a very decent correction before we
I
get
guess
into
there's some news, Steve, that they're going to cut back on the cutbacks floating around the market now.
Yeah, they've already announced that
Yeah.
during the last weekend, but still that didn't manage to move the market
No.
lower.
No.
That's why I also believe that there is a decent chance that we're going to see one more high
Would love it.
before we actually turn lower.
Maybe everything peaks with the S&Ps, metals, energy. They've all gone up together, right?
It is very likely. It is very likely that we're going to see short-term pullbacks in all those instruments, and as you mentioned, once we see a pullback in risk assets and stocks. Yeah, it is very likely. It is very likely that even the initial reaction from the metals, as you said, is going to be lower. Because we do know that risk off is going to come with dollar strength, and as long as this risk off isn't based on some threat in the financial system in general, there is a good chance that we're going to see gold going down with S&P and silver going down, especially silver. I mean, we know that silver is, a lot of the demand for silver still comes from industry. So whenever you see an economic downtrend, downturn, there is always that aspect affecting silver as well.
Look at the three driver on, say, like the 2 or 4 hour chart on silver.
Yeah, in any case, gold remains in this ascending channel. Silver remains in this ascending channel. Yes, you're right. I mean, there are a lot of divergences in several time frames. In silver, there is even something more important than all these divergences. There is also this long-term descending channel, which we're repeatedly trying to break through here. And on an intraday basis, we do trade above it, but then we don't close above it for the time being. This is like the 4th consecutive day that we're trying to break through this long-term channel, and we've been unable to do so. So yeah, undoubtedly, in the short term, despite me holding to my opinion that this is an amazing environment for monetary metals, undoubtedly in the short term, the risk reward isn't really there for somebody to be buying at current levels gold or silver. I do believe that they're going to continue higher, but I do believe that you're probably going to get some better price in the short term to buy them.
Let it come to you.
Yeah, let it come to you instead of chasing. Exactly.
Like women.
I couldn't disagree. I couldn't disagree.
Let trouble find you.
By the way, we have a couple of friends who are asking about oil with OPEC increasing slightly production. What's going to happen? My view on oil has been the same for quite some time. Oil is very peculiar because it is controlled by production and it has automatic stabilizers. So I've been saying for a while that prices below $30 are very, very difficult to sustain because rigs stop producing and cuts in production come. So to answer the question, I think we're now, especially with COVID kind of lurking in the background, we're in a situation where oil is going to range around here, $35 to $45, whatever, something like that, unless we get something, we get a big decision coming. Is COVID coming back? Is there going to be a problem going forward, or is everything okay? If everything's okay, then production is going to start increasing from OPEC and eventually from shale producers. But price is going to grind higher. If everything is not okay, price will probably stay around here. Maybe we'll have another leg lower if equities drop a lot, like we had in March. But I think, barring those two events, if we're still here in this kind of no man's land, I think we just range until we get more information. So, obviously with oil being trading as it has been, a couple of dollars either way, I consider noise. It's not something you can predict. Let's put it this way.
Yeah, I'm 100% with you. Anything else from Lagarde, by the way? I'm looking here at the price action.
I haven't seen any headlines coming through.
To be honest, I didn't expect to see any fireworks today, but it's a lot quieter than I would expect so far. I mean,
Yeah.
I expected something. I mean, not a lot, but something. I mean, this press conference, I can't listen to it as long as I'm on the webinar, obviously, but must be extremely boring or something, right?
Could it be
Yeah.
that maybe no big actions by the ECB because of this ECB parliamentary vote, or there the guy interviewed Monday talking about August 8th. Stella, are you familiar what the vote is going to be in Europe? It's supposedly a very important event for Europe.
Good question.
August 8th.
I don't know. I don't remember actually. If somebody can help us, that would be great. I'm gonna.
We
try
have
and
a
find
very
out.
educated audience. Do you guys remember the interview? But it has to do with whether or not the loan program, support program, whether there's going to be support. He said Italy possibly leaving the EU. That's a vote in Italy,
Is
Itai?
it? Oh, yeah. Actually, I think that might be right.
Is
Hold
there a
on.
vote in Italy on the 8th?
By the way, as long as you're looking
Anyway.
for it, CX, I agree with most of your comments. Trade war definitely isn't benefiting anybody. The whole idea of global trade is based on the very, very fundamental economic principle of competitive advantage, right? Which means the following: instead of each one of us, and by us you can put counters in that, trying to produce everything that we need, what do? You divvy up and you say, okay, what can I produce more efficiently than anything? I can produce more efficiently than anything. I don't know. Let's give something random as an example. Desks. Okay, I'm going to produce only desks, and then I'm going to take the money from
No, debt.
Yeah, that's a different question. Yeah. So I'm going to sell my desks, for example. I'm going to get that money and then buy from somebody else what I need. And if they also produce what they can produce more efficiently, then everybody benefits. So what happens when global trade goes down? It means that, necessarily speaking, you have to be buying some of the things you need from less efficient producers, or you have to produce yourself some of the things, although you can't really produce them as efficiently as others, right? So a reduction in global trade is always an economic, an economic problem. I mean, it has negative side effects. Now, I disagree with your comment. I mean, yeah, I do agree that some short-term shortages can happen, but in general, the dollar is not something that is in shortage. Quite the opposite. Also, having to do with inflation, yes, we've been saying that for a long time here. I mean, inflation is coming this time. It's not going to stay in financial assets. So, yes, obviously, we're going to see an increase in retail prices as well. I think this is inevitable. And I think that's going to be the beginning of the end of this, stupid kind of system we've now created. And yes, I also agree that China is actually extremely helpful, not only for the reasons you mentioned, that they actually managed to keep prices down by producing cheaply. You're forgetting two of the most important functions that China serves, especially for the US. The first one is that the US manages to export inflation to China. It's not only that it keeps inflation down because you can buy products at a lower price, is that a lot of the money that are going around, for example, in the US, and not only in the US, are money that have actually been created out of thin air, which would immediately or almost immediately create local inflation, but it's not the case due to the huge trade deficits. Because the huge trade deficits, no matter how perversive it sounds, they actually help keep inflation down, because you have a huge trade deficit, which means that you're importing a lot more goods than you're exporting. How do you pay those goods for? With money created out of thin air. So the definition of inflation. So you are exporting your inflation to China. And China then, the third function that China serves is that it takes that money, which, they're not that stupid. I mean, they've already bought in the past a lot of treasuries, and I think that, by now they must realize that those treasuries at some point are going to be more or less worthless. So what are they doing to the money they get back so they don't have to hold them until they're worthless? They are reinvesting them by buying US assets, more tangible stuff that will hold their value more than fiat currency, right? So then they come back and they help prop up US assets by recycling the money they get and buying actual assets. So for the time being, China serves all those three purposes. Of course, Chinese leadership, they're not stupid. I mean, they do have a plan in the end, right? And the plan in the end is, as I said, using all that money to buy actual assets, and then they will have real power.
They have a 100-year plan, not a 4-year plan.
Of course they do, because they have the flexibility to have a 100-year plan because they don't have to be voted in power, right?
Tavi Costa is here.
Okay.
From Crescat Capital.
Enjoy the interview.
Keep your day job, man. That's what people tell me all the time. When I sing, they say, Dale, keep your day job. All right, Tavi. Thank you, Steve.
Thanks
for coming. Oh, thanks for coming back, buddy. I'm going to get you set up here. Promote you to a panelist. And where are you? There you are. Welcome back to Face, Tavi.
Hey, Coach. Can you hear me well?
Can you turn it up just a little bit, bro?
Yes. Hold on. Does that improve or not?
A little better. It'll work. So are you planning on sharing your screen today, Tavi? Or do you want me to share mine?
No, I don't have anything here on my screen. Let's say
I'll share mine, and we'll run over the board. What I'd like to do initially is congratulate you. This will be a nice little promo for you on your great March.
Thank you.
That you guys took advantage of it. I've talked to you 2 or 3 other times now, Tavi. You're becoming kind of a regular here.
Well, it's always a pleasure talking to you, and thanks for the introduction.
Yeah, so you guys were bearish. I mean, I said you're not the average bear because you're not always bearish. So the average bear is always bearish. Permas, you're not perma, but it's one thing to make a profit. It's another to take it. So why don't you tell us on how you managed your profits on that COVID crash, and are you still maintaining that position, or most of those positions? I'm sure were short or bearish positions during this recovery, and has the magnitude of this recovery, saying the S&Ps, surprised you?
It certainly did. Even though I think it's the beauty of having a portfolio that is composed by a lot of ideas rather than one or two. And we've always had a strong view about precious metals. And I think it all comes down to not having organic growth in the economy. Back in March, the shorts did really well, and our gold positions and precious metals positions actually didn't. And it was fine. That was what offset and the performance, and really drove the strong performance for the first quarter. For the second quarter, believe it or not, we were net short the entire quarter. The only difference is that we allocated to more asymmetric bets in the precious metal side by buying a lot of the drill stories and very junior exploration stories, and those took off. We've been taking some activist stakes in some of those drilling or drill stories right now. And, it's for us, it's been great. I mean, we've partnered with geologist Quentin Henney, a world-class geologist, and it's been very helpful to look for the best opportunities in the industry, as we believe this is a one in a lifetime opportunity. I call it, there was the big short. I think this is the big long.
Okay, so I'm showing gold up here. Actually, Tavi, I'm looking for a short next week. I think it's pretty crowded, but long-term trend, you can't argue it. Okay, this is tactical.
Yeah.
It's interesting you bring up, people think that, okay, if you're bullish gold, I just go out and buy a miner, but it's a whole universe within the mining sector. You have, mature producers that would be like an IBM in the gold space, and you have royalty companies, and you have exploratory companies, and normally they're later stage in the market because price has proved that, gosh, if we hit a nice vein, this is going to be a big winner, this deal. So do you think we're in that state where, let's face it, compared to Newmont, some of the things you're talking about are on the higher end, maybe even the highest end of the risk spectrum in mining?
Look, I think the entire industry looks attractive. However, answering your question, since the March lows, what we wrote about calling the blood on the streets was in the mining stocks. If you actually look at, yes, if you actually look
this
at
was
those,
it. This was the COVID crash in GDX.
yeah. Well, and what's interesting about this whole thing is that usually investors tend to put more capital to work in the companies that are bigger and more famous companies, the Barrick and Newmont and Kirkland's of the world.
Right.
And certainly that was what happened back in March and April. But now, as you see the whole industry starting to work, and more investors are kind of heating up to the whole industry and understanding that if there is no organic growth, then we'll be relying more and more on monetary and fiscal stimulus, or I should say monetary stimulus to fund the fiscal stimulus more and more often. I think what we're going to see is inflows towards the entire industry. And if there is one part of the industry that is absurdly undervalued, in my view, is the junior exploration side of things. And it does require some level of knowledge in the geology side to navigate that part of the space. But even the junior producers, which are the smaller ones that just started their production recently, those are the ones that you can find trading at 5-10 times free cash flow yield, or I should say times free cash flow, which is absurdly different from tech stocks trading at 30, 50, 60, 70 times sales.
Great point.
And I think the mining space is where you find growth, and it's not in the tech companies. The tech companies actually are cyclical, and earnings are supposed to drop by about 20% this quarter. Miners, on the other hand, not talking about earnings. If you look at free cash flow, it's supposed to double this quarter. That never happened in this whole industry. So I think that's where the level of opportunity is ahead of us still.
Where's break even on production costs nowadays, Tavi, in gold?
That will depend so much on the company.
On the mine,
it's not. That's going to be a very. I think it's might be even misleading to mention that, because every company will have a different break-even point. But a lot of those companies already make money at $1,500, $1,600. Significant amount of money in those levels, with gold prices at those levels. What's interesting, though, is that we're seeing a huge divergence. Usually, gold prices actually follow the capex cycle of the industry very closely. In other words, as gold prices rise, you would expect them to be spending more. But in this last 2 to 3 years, we're seeing a divergence in those. In other words, the capex actually in aggregate of the overall industry is not rising in the same level as gold prices. It seems to me miners are very scared that this is another 2016 environment in which gold prices begin to rise, and then we take another break for another 2 to 3 years, and capital completely dries in the industry, and a lot of companies go bankrupt. But I'm afraid that's a very different scenario today, and which means I think gold prices are going to lead the way, and silver prices will probably go exponentially higher in miners. And if that's the case, I believe margins and fundamentals will follow along for the miners, and we're going to see an appreciation for the entire industry.
Any interesting silver issues that you guys are committing to?
Issues, you mean in a bad way or in a good way?
Shares,
Oh, yeah, I think
mainly
there's
a silver miner instead of a combination pure silver.
it's very difficult, as you know, to find a pure silver miner. And given all the fundamentals for silver today, it sounds very appealing to look for those. We are actually focused in a lot of silver new discoveries, as I believe that the overall industry will be looking for new discoveries very soon. And those companies sitting on large silver deposits will be in a very interesting spot in a few months or years. So we've been disclosing a few activist deals that we've had recently. I mean, Condor Resources would be an interesting, silver related deposit, or
Symbol,
Eloro.
please.
Oh, it's such a small business. It's
Okay.
it's like a
Bulletin
10,
board.
20 million. Condor Resources, like CN, Space CN, so it's in the Canadian TSX exchange, or Eloro, which is in Bolivia, as another perhaps could be a world-class silver deposit in a few years if proven correctly. And again, those are all speculations on what they have in terms of precious metals in those properties. But at the valuations that we're paying today, we're essentially buying just the property and guessing if we have silver or not underneath, and using the expertise of a geologist. I think that will be it takes you to a different level of conviction on the investment.
How about geographic risk, political risk? I know a lot of people at times, because there have been time periods in the history of this business of mines being nationalized, and I was wondering if there were any areas, if the mine was located in that country, that you would avoid.
Yes, I think that that's a huge point, even though it cuts both ways. There's a negative part of the unsafe jurisdictions, but also they come with, number one, with the discount, and number two, a lot of the miners that have production outside of the US is one way to be long gold against the most overvalued currencies in the world today. And I'll elaborate on that. The companies that have production outside of the US also have significant FX exposure. So as you see the depreciation of emerging market currencies, it tends to boost the margins of those businesses, as their cost is actually priced in FX in an emerging market currency. So that's just another way, as I said, to be long gold versus the most overvalued currency. So you have miners in Argentina, Brazil, Bolivia, Colombia, Africa, and those are all areas. Even Canada, as we've seen, the Canadian dollar depreciating versus the dollar in the last few years, and that's all very positive for those businesses.
So actually, that's interesting. A strong dollar actually works in favor of these companies you're talking about.
We're talking maybe different in different terms. I'm referring to a strong dollar relative to the other currencies. I think
Right.
we're in a race to the bottom for all the fiat currencies and
Right.
globally. But I think the dollar is fundamentally better than any other currency in the world today, and therefore, if I believe the other currencies will depreciate faster, I think that that's going to help a lot of businesses to have FX exposure in terms of cost.
Okay.
And I think that that's all, along with gold and silver prices going higher. Number one, I think for you to get it right in terms of the mining space, you got to get it right on gold side and silver side. Otherwise, everything is wrong. So the whole thesis and the premise of the thesis it really is, can we see organic growth? If we do, if fundamentals improve on their own without any need for monetary stimulus further, I think that will change the entire environment against our thesis. I really don't think that will be the case. Miners just had their best quarter ever, over 44% above the S&P 500, 30% above NASDAQ. I mean, tech stocks are on fire. If tech stocks are on fire, miners are on absolute fire, and over 20% over Bitcoin. I mean, I couldn't express enough how bullish we are and how we think this is just the early innings of this movement.
Sure. Plus the total market cap of all the things you're saying, talking about is probably one day's trading in IBM. So it
Yes,
doesn't take as much money to go through that garden hose or even a thin, a straw
yeah.
for that asset class to perform. Probably not
Yes.
even. Is that true? You've noticed that too, right?
Yes, I'm
So,
guessing you. Yeah, go ahead.
so
Sorry.
they're saying that like about uranium. If you look at gold shares and their market cap, of all of them, that uranium space is even smaller. You have a view on uranium?
I do. I think most commodities, especially the ones that are not cyclical, are heading higher in the following years. And it's,
Okay.
in my view, it's also a major reason why we haven't seen inflation. It's quite difficult to see inflation rising when you have commodity prices in a depression, which was the case for the last decade. I strongly believe that the following decade will look quite opposite. Regarding your other point about the size of the industry, you're absolutely right. And I think you're referring to a chart that I produced a few weeks ago, talking about Apple being 3 times the size of the entire
Yeah.
precious metals industry. And
Right.
that's including mining businesses and service businesses in the industry too. So, the overall industry is worth about 0.7% of the global equity market. So, like you
Yeah.
said, it's not necessary a lot of capital to move this industry a lot higher. And it's the only industry that I believe that truly benefits from this environment that we're seeing of money printing and fiscal stimulus to eternity.
Any any COVID risk that you see, Tavi? Miners get sick or shutting down mines because of that, and probably wouldn't happen in Brazil, your home country, because
Yeah.
the president wants business as usual, like the U.S. here. So, but is there any COVID risk or effects on the mining industry?
Well, absolutely. I think the virus is truly the uncertainty that we're if you deal with the markets, as you know, uncertainty is part of the game. But the coronavirus certainly is a type of uncertainty that who knows what's going to be playing out in the following months and years along with this virus outbreak. But I think that's all relates to the constrained situation with the supply of gold and silver that has been already constrained for so long. Just for the average listener, for a normal miner to get a permit to start mining, it takes you at least 5 years. So, if we don't get those companies starting to mine anytime soon, especially silver, we're going to be on a lack of supply here very soon. Copper is in the same scenario. Unfortunately, it's such a cyclical commodity, but gold and silver supply is extremely low, historically low right now in terms of the new discoveries. And I think you're either looking for places where companies are actually sitting on valuable deposits, or you're just holding the metal because of the divergence between supply and demand. I don't think that supply, in terms of the demand, I don't think that's going to change anytime soon. Investors are looking for alternatives for the monetary system, and gold and silver certainly serve that purpose in a huge way.
Looks like you're a little negative on Australian housing here, Tavi. I'm showing your website here and showing housing credit. Are you seeing similar things across the globe, or is this Australia specific? Could it happen in the US again?
That's a really good question, because I think it all relates to our views about China. And we've had a very negative view on China for some time now, which relates to the size of the banking system relative to the GDP that is, in our view, largely inflated. And I believe strongly that the Canadian and Australian markets are highly linked to the Chinese economy, along with Hong Kong and Taiwan as well. And I think it's quite interesting when you see credit starting to disappear, or at least contract in an area where depends on credit growth so much, which is the Australian case, especially in the housing market. that is a housing, that is a market that is, historically overvalued, as we all know, along with the Canadian housing market as well, which in our view, it's been exacerbated by capital outflows from places like China and the elites of China getting money out of those places and buying properties where there's less capital restrictions and also a much easier environment for you to allocate your capital versus the U.S. So, it's I think it's very telling when you have banks starting to, and especially also between the relations of Australia and China recently have certainly heated up, as you know.
Heating up.
And so I think that it's all related to this chart as well.
Okay, and we're only about 3-4 months away from an election here in the U.S. You may have heard of what's going to happen. Or maybe it's going to happen. We could have martial law before that happens. So anyway, I'm wondering if you guys are starting to factor in potential change or re-election of President Trump into your narrative.
That's a tough call, but I lean towards the side that certainly markets at record overvalue levels in terms of the Nasdaq, especially, which is a very cyclical part of the market. I think doesn't justify the risk of a Democratic Party taking control in a few months. And I think that there's a lot more to that. Personally, I just posted a chart looking at corporate taxes, for instance. I don't think the government can afford having corporate taxes this low, given, I'm a big fan of cutting taxes. However, I just don't think that the government is fundamentally strong to support such policy going forward. I think
you're looking for higher taxes no matter who is elected.
It's going to be tough to see Republicans doing that, I think. But but it's again, it's another risk that is certainly not priced in the markets today. It's a very small percentage of the collection of revenues and taxes by corporations, actually by the government. However, it's certainly what moves a lot of margins for companies, and we've seen margins actually plunging recently. They have nothing to do with corporate taxes. Matter of fact, they have been helped by corporate taxes being lower. So I think that there is a case to be made on the bearish side here. That given the overvaluation of stocks overall, I think that there is a little bit of mispriced risk in the markets in terms of that.
How about yields? If you look at the yield chart for the last, going back to the COVID crash down there, it looks like an EKG of a guy in a coma, Tavi. There's your 10-year yield right here.
Yeah.
You have any view on, do you have any view on yields? They're going to be an important part of an overvalued market if they start heading up, which it would really be kind of very contrarian. Everyone's saying lower for longer. Does that mean new lows in 10-year yields and maybe even the 30-year?
So my view about yields is actually linked to my views about gold in the terms of, as the government is, as we don't see organic growth and the government continues to have to do fiscal stimulus, the Federal Reserve has to be the buyer of last resort here in terms of treasuries, and it so suppresses long-term interest rates. At the same time as you expand the monetary base, and that creates a supercharged environment for precious metals in general. Now, answering your question, in terms of the 2-year yields, I think it's something I have a higher conviction on. I believe that the 2-year yields are likely to go negative sometime soon. And I think the biggest impact of that, aside from precious metals, would be on banks. You look at places like banks like Wells Fargo already down at least close to 60% year to date. I mean, that's the worst annual performance of Wells Fargo in its history. That's the 4th largest bank in the U.S. with over or close to $2 trillion of assets. So it's a significant, a significant company to be looking at in terms of problems going forward. So as you have low yields, record debt, and record valuations, I think it's going to be very difficult for us to see organic growth improving here going forward. So I think yields go lower, especially in the short end, on the front end of the curve.
Okay, so why don't we wrap it with this? And already want to thank you for a great conversation. But would you
Absolutely.
say, if you look at my charts here,
Okay.
that with the S&Ps in this position, and here we were before the COVID decline that Crescat capitalized on, are you making the same bets now
Mm-hmm.
in the market that you were making back then? Do you think are you reloading after this big recovery here with your bearish view of the economy?
Yes, we reloaded a lot back in March and April, and then added back after the move of 20-30%. We have a very big short position today. We think the sentiment is euphoric in a way. There's a lot of bears capitulating recently.
Yes,
We've had
plenty.
the entrance of Robinhood traders now trashing in-depth
Yeah.
research and 10Ks and 10Qs and mocking Warren Buffett, and investors bidding bankrupt companies and saying fundamentals don't matter, while
Right.
you have all the
Hurts.
fundamental side, profit margins falling apart, capex is not improving. So again, I think that's there is certainly a divergence between economic activity and valuations, and I understand the market is supposed to be looking ahead, but I think that we've gone a little bit too far on this idea of a rocket ship recovery.
Right.
That I don't think we're going to see. I think labor markets are going to be weak for longer than most believe. And I think valuations has just put out a table looking at 7 different ways of looking at valuations. And pretty much all of them are very close to all-time highs. And that's using Q1 numbers. The Q2 numbers are not even out yet. I think that's going to look abysmal. And probably going to be one of the worst ones in history in terms of multiples overall. So I think that there is a case to be made of buying gold and selling stocks to continue here going forward. And we've been adding to our shorts after a very good month and quarter for the precious metal side.
Okay, so do you think we just correct this correction or advance, or that the March lows are going to give way over the next 12 months? Best guess.
I do. I think my best guess is that we're going to go lower. And I think there's there's some asymmetry to that. If you look for companies that are absurdly overvalued, most of them are in the tech space, in my view.
Okay, well, Tavi, I really want to thank you for coming here and sharing your view. Very interesting take on miners and sectors within the mining group. And everyone, you could follow Tavi on Twitter at Tavi Costa, right here. I had you. There you are. At Tavi Costa. And you can go and check out his writings and his views on Crescat.net. So thank you, my trading warrior brother, and great to get some balance and your input. And again, congratulations on having a great quarter. But Tavi, you and I have been around for a while, and in our business, you're only as good as your last quarter.
That is true.
Right, buddy? Huh?
I would say it's your last month as well. But
and in my business, you're only as good as your last trade.
Yeah.
Okay,
I
so
agree with you.
I wish you successful quarters, and why don't we set something up to talk again in the fall and see how things
Absolutely.
are playing out.
Sure thing. Thanks for having me. I appreciate the interview again.
Why wouldn't I have my trading warrior brother come in here and talk about speculative investments like exploration stocks and miners? Okay.
Always happy to be here.
Enjoyed it, buddy. Everyone,
Thanks.
thank Tavi for being with us. That's going to be a wrap for us today. We'll see everyone tomorrow for TGIF Friday. And don't just count your pips, count your blessings. And we'll see everyone tomorrow. Adios. Thanks, Tavi.
Thanks again. Bye.